Scanlan, the CEO of Barton Gold. Alexander, great to be speaking to you again. How are you doing? How are things?
Doing well. Thank you for having me.
No, it's good. It's good to be speaking to you. Of course, we did meet in Zurich at the Swiss Mining Institute. You reminded me, of course, of the investment case here. So that's the one thing that stood out to me was when you said you need about 20 million Aussie dollars to unlock potentially 1 billion Aussie dollars. And that's going to be done in two stages. So that stage one is using that central Gawler mill for the low cost production from the Tonkillia. So I think it was around 20,000 ounces a year you were targeting there with a modest capex, sort of between 10 and 20 million Aussie, and potentially generating about 50 million in annual free cash flow. So just remind me if that's correct. And secondly, how close are you to finalizing the production here to get that going?
So firstly, yeah, generally correct. I think the idea really here is that we want to basically create a destination of scale. That's where we have our large scale Tonkillia project. And then we want to create our own pathway to get there, right? So we're targeting 150,000 ounces per annum of production, but we want to be able to get there by starting with our existing mill, starting smaller scale production, and then generating cash and self-funding. So the idea then with the stage one operation is that you don't need to take excess risk. You just need to make that simple transition into operations because essentially there'll be a minor reconfiguration of the plant. And you want to aim for a nice, simple, moderate production startup target and then grow from there. So the idea is turn on the mill. We are doing the studies right now that will tell us exactly how much that's going to cost and need one of three configurations. And start producing about 20,000 ounces from the sort of simpler, lower risk material, get the mill running nicely, and then start blending in some of the higher grade material. So as we do that, we might see production hopefully go from 20 to 30 to 40 to 50,000 ounces per annum while we're bringing the large scale project along. And the objective there is to, yes, essentially leverage or arbitrage our infrastructure, make the step from explorer to operator, but then start generating 40, 60, 80, $100 million a year in free cash. That then takes us up to a large scale production platform.
Indeed. And are you on target? Are you aiming for a 2026 start on that mill?
That's right. So we're aiming for 2026 start. We are currently working through essentially a series of updated JORC resource estimates. In a manner of speaking, we've been very focused on that stage 2 long-term platform. We're now going to come back and essentially update the market on all of the pieces that we have to play with around our existing mill, which we really haven't talked about for the past 4 years. So we'll update those resources. We'll lay out the costs for restarting the mill in our chosen configuration, and we'll lay out the production plan. The objective is to be producing stage 1 by the middle of 2026.
Okay. And is this the optimized scoping study is what you're talking about here?
So the optimized scoping study is for the larger project. This is the
for Tonkillia, yeah. Okay.
For Tonkillia, correct. Yeah. So this is we published an initial test of that project back in 2024, and we've done a series of optimization studies, very PFS-like analyses, to basically dial in what that's going to look like, and that allows us to put that on an expedited project development pathway. So that is all going to be happening in parallel with stage 1, and really the way to think of this is smaller term, nearer scale. Smaller scale, nearer term, stage 1. Starting operations in development with the accelerated development pathway for the larger scale, longer term stage 2.
Yeah. And that's where you get your 150,000-ish ounces a year, all being well, from Tonkillia effectively.
Correct, yeah. And really, with the initial scoping study, what it actually shows is the first year of operations will produce around 180,000 ounces from Tonkillia. So the first year that Tonkillia is running, between the existing mill and Tonkillia, we actually hope to be well over 200,000 ounces of gold. So quite a considerable influx of cash generation when you turn on that second mill.
Sure, okay. And Tonkillia's at the moment got 1.6 million. So you're hoping to increase that as well with the optimized scoping study?
So the JORC resource is 1.6 million ounces, and we've just released that updated resource. So the objective in the optimized scoping study is to make better use of that resource. Okay. So we've demonstrated that we can make very material energy savings. Of course, when we think about outputs from a project like this, well, gold is our primary output. In terms of our inputs, energy is our primary input. So comminution efficiencies and power cost efficiencies are very, very additive to the bottom line. And that is what we're hoping to sort of make gains in the energy, take those savings, and then push those out into an expanded open pit design. And in a number of ways, basically, you want to take those savings, capture more ounces, but we can also basically justify a larger, slightly higher cost pit design because the current Australian dollar gold price is around 5,000 Australian dollars. We'll be expanding our pit optimization from 3,000 to 3,500 Australian dollars. So it's still constrained to about 30% below market price, but we're basically trying to capture more material for longer term production.
Okay. And I remember you saying that you would look to fund stage 2 effectively from profits from stage 1, but also it might be a mix of debt and equity financing. But I noticed you also were talking recently in some announcements about perhaps forward selling some silver credits that you've got as well. So they've got a few options on the table here for funding stage 2, even though it's maybe 2 years away yet.
Correct. Yeah. So I guess the fundamentally the important thing is that a project can stand on its own, right? And Tonkillia, because it has this higher grade starter pit in the middle, and at current gold prices under the prior model, that would generate between $500 and $600 million in free cash. So you're looking at essentially a 1-year payback on the project. So at its root, on its own, it has a very strong financing profile from a debt standpoint. So something that a tier 1 lender can look at and feel good about in terms of de-risking the credit exposure very, very early on in the project. But we also have to remember that, again, this stage 2 project essentially being a corporate expansion project from our stage 1 operations next door, we will also have the advantage of having existing above ground gold pouring cash flowing infrastructure. So our credit profile when we're talking about this a debt package is very different. And we're likely to find, that we are being offered more favorable terms than you might typically find in a standalone startup development. And then the ability to forward sell, whether it's gold or silver, silver might be 3 to 5% of our overall revenues, but it's a very useful tool to look at basically monetizing and bringing forward if you did need to cover the equity. Now, if we're producing 20, 30, 40,000 ounces per annum of gold from our stage 1 operation, the equity components that we might need to bring in terms of capital costs and working capital for Tonkillia might be 150 million Australian dollars. So we should be able to cover most, if not all of that, from the free cash flows from stage 1.
Sure. Okay. And in terms of where you're at with that optimized scoping study, what can investors expect to see on that over the coming months?
Well, in terms of the content, you'll have to wait and see it's published, but it will be published very soon. So we were planning to publish that by the 30th of June. It will be out imminently, and essentially what you would expect to see is what we sort of signaled publicly: energy savings, a larger pit, expanded life of mine, and significantly improved economics, especially in the current gold price environment.
Yeah. Okay. Good. And I noticed from your recent quarterlies here that you've reported a 3.1 million half-year profit on 8.5 million of revenues, and you say that's only from a $38,000 net cash burn during the quarter. So just put that into context. So for an explorer to actually make money and not a loss is unusual.
Yeah. And look, I think, to put a point on that, we actually fully expense all of our exploration expenditures. So we don't capitalize it, which is a nice way of moving it out of your P&L and onto your balance sheet. So we fully expense our exploration, and we did have a $3.1 million profit for the half year ended 31 December against about $5 million worth of exploration work. So, that is a very unusual event for an explorer, to be sure, pre-operations explorer. But we did have a number of grant and tax credit programs that we were able to utilize very efficiently. And we did actually sell $5 million worth of gold. So we produced and sold about 1,400 ounces of gold in the form of very high grade concentrates from material that was actually in our plant. So this is part of our asset monetization initiatives. And we've actually produced about $12 million net of costs internally over the past few years doing that. So this is an ongoing program, but it's one of the ways that we're able to keep investing heavily we're always focused on spending each dollar very efficiently, but we are essentially able to subsidize or fund, co-fund internally our technical work, our program work, and this keeps our sort of equity issuance and dilution very, very low compared to your traditional junior.
Indeed. So, I mean, how are you feeling about the sort of the corporate side of the business here? So you've got a lot of cash there. How are you feeling for going forward to funding all the things you need to fund? But also I noticed that you mentioned in the RNS that Collins Street Asset Management increased their stake to 14.1%. I think they bought on market, didn't they? Which is something that you are really sort of championing. You know, if you want to have shares in Barton, I think you told me just go and buy them. We're not going to do any sort of special deals. So how are you feeling from the manager of this company, the CEO of this company, from a corporate standpoint?
Yeah. Look, very good in simple terms. We have worked very, very hard to build not only a high quality company based around what we believe is a very high quality platform, and I think we're demonstrating this both in word and deed. But we've around these principles built a very, very high quality share register. So we get a lot of support from our register internally. Collins Street is a fantastic example of that. They originally entered our register after some conversations, really getting to know them getting to know us and understand, I think, that they could take faith in what we were saying and doing as a development team. And learning more about the very, very broad and deep experience that we do have inside of our team for being a small junior explorer. They have been buying regularly on market for a long time. We actually helped coordinate a block trade between some of our older investors and them as well. So to have that kind of support is really great. And then back to the core of the question, in terms of our ability to fund these things, we've talked a little bit about stage 2 and how we think that will be funded by stage 1 and maybe some forward sales. In terms of the sort of capital bridge that we need to cross, so to speak, for stage 1, as you've highlighted, it's very, very small. And again, we do have the benefit of existing above ground infrastructure. So my background is actually principal investment and structured finance, both equity and credit. I'm very confident that we will be able to leverage the infrastructure that we have to majority debt finance what we are doing. And we have a lot of interest in any equity that we might place in the future. But as you say, it's not something that we need to do now. And we'll be quite selective about if and how we do that.
Sure. Okay. And just finally then, Alexander, what would you say is your long-term vision for the company, and more importantly, how you get from sort of point A where you are now to point B, which is effectively achieving that long-term vision? You said that you're getting into starting that mill and getting into cash flow from producing the gold there 2026. So that's less than a year away. So it's not too long to wait. But if you'd have set out some of the key milestones along the way to getting to that first stage and then the longer-term vision.
The immediate milestones are obviously essentially bringing forward now more detail about the specific pieces that we're going to use, in what order we're going to use them. So basically, which materials are we going to put through what reconfiguration of the mill, and what will that produce? And then, of course, what is that going to cost us to do that? And what will it yield? What will it return? And what will the cost of operation be? All of these things are things that we're going to be laying out to the market in the course of the next 3 to 4 months. So it's a very short horizon to essentially crystallizing. I think the market is starting to understand, starting to become aware of the fact that we are a very short step from being a cash flowing producer and a very low cost step. People started to become aware of this, but I think when we put some hard numbers around it, it's going to spur a little bit more of this is really as short a step as we thought it was going to be, including financially. So then going along, beyond sort of detailing that, then for us, it's a case of bringing in our partners and, procuring the right contractors to come and make the mill modifications, and then essentially building our operations team. And we'll use a third-party mining contractor for the bulk of the operations. So we'll keep it simple, we'll keep it clean, we'll keep it tight in the company. And once we have that going, it's really all eyes on how do we now get Tonkillia into accelerated development. And in terms of the long-term picture, we are always looking 3, 5, and 8, 10 years down the road. So when we think about Tonkillia being an objective to produce in aggregate, on average, 150,000 ounces per annum. I guess what I would suggest today is by the time that's actually happening, we'll already be thinking about where the next 100 to 150,000 ounces per annum is coming and be very advanced on that. So the objective here is to continue investing our shareholders' funds effectively, to continue generating value, but also to return that value while extending the life of the life and activities of Barton over time. We have the only mill in the region today. We will have the only 2 mills in the region. We will be the only power generator in the region. So even though many of the projects that will come online around us may not be gold projects, many of them will be relying on our economics. So we would anticipate our infrastructure. So we would anticipate continuing to expand our influence, not only in gold, but also the provision of infrastructure and energy to other operators in the region as well. We'd like to see these sort of diversified and de-risked cash flow streams in addition to gold production.
Okay. Excellent. Well, thank you so much for your time today, Alexander Scanlan, the CEO of Barton Gold, and hopefully we can catch up maybe in the next quarter just to see how things have progressed.
It would be a pleasure. Thank you.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.